Para presentar estas presentaciones, le voy a pedir a mi amiga Ana Fisher, de la Embajada de Canadá, quien además es la gestora de que estas presentaciones estén hoy acá, para que ella se haga cargo de este momento de Canadá. Muchas gracias. Ana.
Bueno, muy buenos días. Antes que nada, agradecer a la Secretaría de Energía y al IEPG por la invitación y por el interés en conocer más de la experiencia de Canadá con el gerenciamiento del carbono. La verdad es que, bueno, como lo mencionaban Hernán, Josefina, Teresa, creo también esta mañana, los proyectos en Canadá debutaron hace ya bastantes años, impulsados por los gobiernos, tanto federal como provinciales, principalmente de las provincias del oeste de Canadá, de Alberta y de Saskatchewan. Ese impulso hizo que ya hoy en día haya como aproximadamente 6 proyectos comerciales en Canadá, de los cuales podemos sacar lecciones aprendidas. Y esa es la idea de hoy. Invitamos a 2 organismos, una consultora canadiense de la provincia de Alberta, para que nos presente un poco el panorama regulatorio y económico de estos proyectos, y otra de una ONG de la provincia de Saskatchewan, para que nos presente un poco más las lecciones aprendidas desde el punto de vista tecnológico del proyecto de Boundary Dam. Voy a presentar entonces ahora a GLG, que es la consultora canadiense que está involucrada en gran parte de los proyectos que se están dando ahora en la provincia de Alberta. Una de las oradoras es COLLEEN Sherry. COLLEEN es vicepresidenta de sostenibilidad de GLG, encargada de asesorar a los clientes en descarbonización, transición energética, informes ESG, certificación, producción responsable y tecnologías emergentes. Es licenciada en Geología con especialización en Geofísica por la Universidad de Calgary. Tiene un máster en Ciencias de la Tierra por la Universidad de Ottawa, un máster en Administración de Empresas por la Universidad de Queen y de la Universidad de Cornwall, y otro máster en Liderazgo para la Sostenibilidad por la Universidad Estatal de Arizona. Además de su trabajo en GLG, COLLEEN trabaja como asociada académica global en la Escuela de Sostenibilidad de la Universidad Estatal de Arizona y es miembro de la Sociedad Canadiense de Energía Evolutiva, si es que está conectada. La acompaña DEVIN, LACEY, que es el director de desarrollo de negocios de GLG, con experiencia en ExxonMobil, Nalcor Energy y Suncor Energy. La carrera de DEVIN como asesor financiero y comercial comprende algunos de los mayores proyectos de exploración y producción de Canadá. DEVIN se unió a GLG en 2020 y gestiona proyectos de clientes en área que incluyen la captura, utilización y almacenamiento de carbono, hidrógeno, modelización económica, asesoría comercial y regulatoria e informes técnicos. Es licenciado en Comercio por la Universidad Memorial de Terranova y posee un máster en Administración de Empresas por la Universidad de Calgary, ambos especialidades finanzas. También posee la designación de profesional en gestión de proyectos y es miembro activo de la sección del Instituto de Gestión de Proyectos del sur de Alberta. Bueno, perfecto. The floor is yours, Devin, COLLEEN. Go ahead.
Thank you, Anna, and thank you everyone for this opportunity to present to you today. We're going to be walking you through carbon regulation and CCS economics. We're utilizing a Canadian example to provide you with some information that can hopefully benefit you going forward. So we'll give a very brief introduction to GLJ, and then we're going to do a quick kind of compare and contrast between Argentina and Canada, then go through climate regulation and pore space regulation, then go into CCS economics, and then wrap up for you today. So GLJ, as Anna's already introduced ourselves, but we are just over a 50-year-old company, headquartered here in Calgary, but with working around the world. We have over 110 specialists on staff, largely engineers and geoscientists, but also many business and data analysts, as well as sustainability professionals. And we work with clients globally. I just want to show the next. And here you can see how we are spread around the world, but most specifically in the yellow stars are work that we have done with CCS on a global basis, which of course is of most importance for the conversation today. So we have a broad breadth of services, but all of which we'll be utilizing today to demonstrate how Argentina can look to what Canada has done to hopefully move forward in this CCS industry. So we'll start first with some regulation, and we're going to start here simply because without regulatory context, it is very challenging for CCS to move forward successfully and for investment to be made into CCS projects. So we'll give some background through regulation. So for you to understand why a Canadian group might be talking to you, we just wanted to kind of show some similarities between Canada and Argentina so that you can understand some of the frameworks that might be similar that would be derived from that. Both nations have federally mandated focus on climate change, of which CCS feeds into it very clearly. We both are participating in the Paris Accord, and then a very diverse energy resource base. So the countries need to be committed both to developing that energy resource base as well as to ESG and sustainability. And this is showcased in the Paris Accord through increasingly ambitious nationally determined contributions from both countries. Another similarity is just, as we've already talked about, the resource base, but it's also that dependence on fossil fuels, both from a revenue generation perspective for the countries, but also from the usage and the utility aspect of both countries. So very similar background in focused predominantly on natural gas and oil. And more specifically, a good comparison that's important to CCS opportunity development is the fact that both countries have a rich opportunity base because of the geology inherent to the nations. So both countries have quite a number of sedimentary basins, pre-existing reservoir understanding, and therefore the opportunity to develop those reservoirs and also reservoirs that have saline aquifer systems within them, using that as the basis for the CCS industry. So let's jump into some of the climate regulation to give, again, a supportive context through which maybe the Argentinian regulatory system might benefit from some of the things that have already been done elsewhere to set up an opportunity for CCS as an industry. The international policy, we've already talked about the fact that both Canada and Argentina are involved in some of this international policy. So whether it's with regards to the UN Framework Convention on Climate Change, so the UNFCCC, through the Kyoto Protocol and through Paris Agreement, all of this is that backdrop on an international basis as to why a country wants and needs to look for emissions minimization, and CCS is very much a part of that. So these nationally determined contributions, again, it's another part of commitment to the Paris Agreement through the UN, and both Canada and Argentina have NDCs that they have committed to, quite similar in the sense that there's that net zero emissions target by 2050. But the other thing about this is the recognition that these, although you set a target for emissions reduction, they are not policy prescriptive. So these are meant to inform the conversation, but it is not telling you how you must achieve it. And these are considered living documents. So as technologies and opportunities evolve within your country, you can look to adjust your NDC appropriately. This is just, it's meant to be a very busy slide purposefully. And what we want to look at here are just some of the momentum and regulatory change that is happening within Canada over the last number of years. So one of the things I want you to note here is that on the left-hand side, we start at 2007, and heading to the right, going to 2023. The pace of regulatory change is increasing rapidly, and many of these are around the emissions specifically, sometimes separating out methane, but oftentimes just greenhouse gas emissions equivalents, so on that broader basis. You'll also see here that we link in aspects of economic growth through here as well, whether it's with regards to the cost of carbon, so carbon tax, or whether it's with regards to the budget, the national budget, and contributions, investment contributions into CCS. One of the things that needs to occur prior to initiating a carbon capture and sequestration industry is an understanding of pore space ownership. So specifically in Canada, we do have an act that covers pore space ownership. So it is something that does need to be fully defined and understood on both a national level and also in a more jurisdictional level. So very briefly, Alberta, which is the province that Calgary sits in and where Devin and I are speaking from today, Alberta has taken that national understanding of pore space and taking it a bit further because it is fully defined by the provincial government as part of the resource base within the province. So Alberta has basically taken over the pore space or claimed ownership of the pore space so that all companies interested in CCS applications need to do it on a leasing basis from the province. So basically, the province expropriated this as a subsurface property, and it is through the government of Alberta that this resource is distributed for access to companies who apply for CCS project. Would you like to say? The other aspect of regulation that's really important is the understanding that both incentives and compliance are two really important pieces. So from a compliance perspective, Canada has taken the path of a carbon price. The carbon price has been incrementing since 2019. So in 2023, we are at $65 a ton, and it is incrementing at $15 a year to 2030, at which point we will be at $170 a ton. Within Alberta, there is a unique aspect of how we apply this. So provinces were able to, as long as they were following the letter of the law with regards to the cost of carbon, provinces were able to adjust their methodology of rolling that out. So within Alberta, it is called the tier regulation, so technology, innovation, emissions reduction. And basically what that means is within the province, we capture the carbon tax and we utilize that to incent technological evolution largely with regards to emissions reduction. The other piece of this is what is known as a clean fuel standard. So this is simply in its simplest form is an additional tax on top of the carbon tax. And it's meant, again, to incent low carbon intensity technologies and fuels going forward. The last piece that we'll talk about here, as we said, there's the stick, which is the carbon tax and the clean fuel standard, and then there's the incentives. The incentives within Canada are provided to us through the federal budgets. So every budget year, starting in 2021, and here is the details in 2022, the government has rolled out the incentives, and they are supporting carbon capture sequestration through funding of equipment and of transportation, storage, and the use of said equipment. So this is 2022. 2023 just rolled out additional incentives. And now I will pass this on to Devin so that he can talk about how some of those sticks and carrots might benefit projects.
Thanks, Colleen. As Colleen mentioned, what we want to do in this brief case study that we've put together using publicly available cost data from a Shell Quest project here in Alberta, what we want to do is take that cost data and see if we can run some economic models and do some scenario analysis with regards to how that regulation that Colleen reviewed actually applies to a project's economic performance. So the first two things that we want to review prior to getting into the case study itself and looking at what costs we applied and what scenarios we applied, the first thing we want to do is do an overview of two things, and that's the key policy drivers that you actually built in to your revenue or your cost basis when you're modeling out your CCS project. And then the other thing we're going to look at next is what commercial agreements tend to look like here in Western Canada between large-scale CCS hub operators and the emitters that they're meant to serve. So on the policy page, the first thing that we're looking at here is carbon pricing. And Colleen had made reference to this. The carbon pricing in Canada is really the backbone of the revenue driver for a CCS project. Without carbon pricing and therefore abating tax or receiving carbon credits, depending on your emissions performance, without either abating that tax or receiving that credit, there really isn't a foundational revenue source for carbon capture and sequestration. So carbon pricing in Canada is currently $65 per ton of CO2 equivalent, and it will be increasing by $15 per ton up to $170 in 2030. The other thing that Colleen had referenced, and it's more of an incentive versus a stick, so to speak, is the CCUS investment tax credit from the federal government. CCUS ITC allows for a significant portion of capital requirements to be funded by the government in the way of refundable investment tax credits. So you can actually get up to 37.5% of capital funding for capital required for transport, storage, and use equipment. And you can get up to 50% of capital funding for carbon capture equipment. And so this has been a really important incentive in terms of funding for CCS in Canada. It is our largest source of funding dedicated to specifically CCS. The other two pieces of policy that we see here, we're actually not going to model those in our case study today. Our case study will be focused on carbon pricing and the CCUS ITC. But they are important to note because within the Clean Fuel Standard, the purpose of that policy is to reduce the carbon intensity of liquid fossil fuels. And if your CCS project is within the value chain within the value chain that allows the reduction of that carbon intensity to occur, then your project could be eligible for Clean Fuel Standard credits, in which case they are stackable with carbon pricing and they're stackable with the ITC and could be an important driver if your project is specific to that type of value chain. Then we also have a number of sources of grants and funding from both the provincial and federal levels. And again, you're allowed to receive these on top of the prior policy that we've also looked at. So different funds that exist are the Canadian Infrastructure Bank, Strategic Infrastructure Bank, the Net Zero Accelerator Fund. These are all major sources of funding that Canada and its respective provinces will run at different points in time. And so that's the key policy drivers we're going to use to run our case study. And then what we also wanted to look at is the commercial terms or the commercial agreements that are currently being negotiated here in Western Canada. Because the way that Alberta specifically has gone about rolling out CCS development in the province is that they first wanted to start with large scale open access CCS hubs that not only reduce the emissions of the operators that owned those hubs and operated those hubs, but more importantly, they wanted them to serve other large heavy emitters throughout the province, like power generation companies or petrochemical companies. And so the first thing that our provincial government did in rolling out CCS was awarding pore space to large-scale operators. So there's currently 25 evaluation permits awarded in our province, and 25 prospective proponents are trying to develop large-scale CCS hubs targeting deep saline aquifer pore space. And so what they need to do is go strike offtake agreements with emitters that are going to invest in carbon capture. And so there's commercial terms that get agreed upon between these two parties, and these commercial terms can drive a lot of different scenario analysis when you're evaluating your economics. So the primary revenue driver for a CCS hub is a service fee. A CCS hub, as mandated by the government, is meant to serve emitters by charging them on $1 per ton of CO2 basis. So they'll charge them on $1 per CO2 ton basis with regards to the CO2 that they offtake from the capture and that they permanently sequester on their behalf. And now this service fee is only the only way that a hub operator can actually charge an emitter a service fee is if that emitter is then receiving the carbon credit for their emissions abatement. So it really is that carbon price that still is the backstop to a hub operator being able to charge this service fee. Other important sort of commercial terms that we see in addition to the service fee are the potential to have the hub operator actually share in a portion of the carbon credit that the emitter will receive. And perhaps that can also de-risk their development and increase their economic case. There's also commercial terms that could be agreed with regards to capital cost sharing. So if an emitter is investing in carbon capture and there is a CO2 pipeline that needs to connect the capture facility with the large-scale open access hub, then perhaps there's opportunity for agreement on sharing in the CapEx for the transport infrastructure. And again, we mentioned clean fuel standard credits and taxes are another potential commercial arrangement that can be included here. We won't look at those today. Just eligibility for CFS is quite complex. Something that is also important to note in Canada is right now, since carbon price really provides the backstop for the economics here, industry wants a certain level of certainty from government on what that carbon price will be between now and 2030 and onward. And so they're actually looking for a carbon contract for difference from the government, which is essentially a type of insurance policy from government that says if the carbon markets are lopsided either way, whether too much supply or too much demand, and the carbon price is not what we had actually said it was going to be over time, then the government will either pay the shortfall to the developer over time, or if carbon credits are actually selling on the open access market for more than what the face value was determined by the government, then the developer will actually have to refund the federal government the excess. And so that's a really sort of important piece that we're currently trying to get from our federal government so that we can have more certainty when we forecast these projects. And the other piece of the other mechanism we find important in evaluating these projects is the potential for the CO2 to be on a take or pay type of system. So the reason this provides financial risk is because if you're a major hub operator and you have dedicated pore space, but the CO2 is not coming to you from that capture partner because of development issues or whatever the case may be, then that's pore space you're no longer optimizing, that's revenue you're no longer achieving. And that's vice versa too. If you're an emitter and you've invested in carbon capture at your plants and you've told your board and your executive team that you can reach your emissions reduction targets by investing in carbon capture and partnering with this respective hub operator, and then for whatever reason that hub operator can't take your volumes, well, then there's probably a financial penalty to pay on either side. So we do note these two important pieces for consideration. And so briefly now, just to look at the Shell Quest project, the costs, the Shell Quest project is a large-scale CCS project here operational in Alberta. It's been operational since 2015, and it was heavily funded by government in 2011, and as such, they were required to publish an annual knowledge sharing report. And within these reports, we get great access to data all the way from subsurface, CO2 plume migration modeling, all the way through CapEx and operations costs. And so what we've done is we've extrapolated the specific costs from those reports so that we could create sort of a conceptual CCS hub that we can talk to publicly here. And so the costs that we extrapolated were specific to a 64-kilometer CO2 pipeline, which is an operational pipeline here serving the Quest project. And we extrapolated all costs to do with their injection field. And their injection field is three injectors each with their own deep observation well, and they're each with their own groundwater monitoring well. And so what we've done to create this case is we've extrapolated the cost specific to that downstream infrastructure, and we've designed it for the same sort of scale and scope of Shell Quest, which is about 1.2 million tons per annum of CO2 over a 25-year operating life. And so when we extrapolate those respective costs, and these are in Canadian, but for reference, $1 Canadian is equal to about 250 Argentine pesos. And so these are the costs that we extrapolate simply for the pipeline and the injection infrastructure. Our total CapEx value is about $217 million Canadian, which includes your front-end engineering and design studies, your owner's costs, as well as exploration wells. Your total fixed operations costs over the 25-year life of the project at a 2% annual inflation rate is about $231 million Canadian. This includes MMV costs, a post-closure stewardship fund payable to the government. This includes your property tax for your pipeline and injection site, as well as your annual maintenance. Total variable OPEX costs that we calculated over the 25-year life was $403 million. A big driver to this is actually the carbon tax payable on behalf of the project, since there is project-specific emissions where you do have to pay carbon tax on it over the 25-year life. And what we've done in this case study is we've actually forecasted carbon tax, as the government said, up until $230 in 2030. And what we've done here is a rather perhaps aggressive assumption where we've kept it at $170 per ton from 2030 onward. So that's why you see our variable OPEX costs increasing. We've also included an abandonment and reclamation obligation of $37 million. And so we take this as our median cost profile just to kind of look at a conceptual hub. And based on those median cost estimates, we just build a relatively simple deterministic cash flow model of that project. And so this is just an overview of the cash flow projections of that project, just assuming that it injects at capacity of 1.2 million tons per annum over its 25-year life. This case assumes that the hub operator can charge its emitters $20 per ton of CO2 as its service fee. So that is the backstop to this. And we've also applied all the investment tax credit funding that we would be eligible for. We have assumed that we would receive the full ITC funding in this case. So 37.5% of our capital costs were funded by government in this case in the form of refundable tax credits. And what we see here is a project that needs a bit of help. The before tax rate of return on this is about 3.4%. It takes about 15 years to pay back. The net present value at a 10% discount rate is negative $50 million. So perhaps not something that certainly contains risk. But again, this to us is just looking at median cost estimates under a deterministic cash flow case. But the reality is when we're evaluating our economics, we really focus on scenario analysis and being adjustable in our assumptions. As you can see, the far left column was the case that we just looked at. It's $20 per ton as our service fee, but we're not getting any sharing in carbon credits with our respective emissions partner or emitter partners. And our emitter partners did not share in any of the capital required to develop our hub. And so if we move from left to right, the center column is the difference in the cash flow projections if we're getting $20 per ton of CO2 as our service fee. But addition to that, we are also receiving 10% of the carbon credit earned by our emitter. So you can see that in an environment where carbon tax increases or carbon credits increase to $170 by 2030, getting 10% access to just 10% of that really de-risks our project. And then in the far right, we see an even further de-risked project where the emitter, we just assume a case where they can cover 25% of the capital requirements. And then finally, we go from a 3.4% before tax return to a 16% and then to a 24%. So really important to kind of understand your assumptions, understand your costs, your range of uncertainty, so that you can look at this through the lens of scenario analysis. And what we just looked at there were deterministic cases. We just extrapolated a certain set of costs from a publicly available data set and applied them to an economic model. The reality is there's uncertainty in those costs. And so what we typically do in our evaluation process is we do stochastic modeling, or we apply a probabilistic distribution of uncertainty to certain inputs in our project that we acknowledge are uncertain. And in this case, we've applied risk to all of our cost profile, our capital costs, fixed OPEX costs, variable OPEX costs. We've applied a level of uncertainty to what we think we can receive as a service fee and to what we think we'll receive in terms of ITC funding. And then what that does is you use a program, a Monte Carlo simulation program, and it'll run 10,000 different iterations of the project, each iteration at different input levels. And you can really start to see the range of outcomes for your project from sort of a P90 to a P10 level, understanding that your P50 level was about your median, kind of represents your median estimates. And so here's sort of the overall summary of what we see when we're modeling our projects. Is what you see here is 4 different service fee scenarios. So we're looking at this from the perspective of a large scale hub operator, and we're wondering, can we charge, what does our project look like if we're able to charge our emitters $15 per ton of CO2, or 20, or 25, or even 30? And as you can see, your economics start to improve, your project becomes more de-risked. And then what you can also see is not only do you see what your project looks like across different service fees, but you can even have a look at perhaps the $20 service fee there, that black line, our P50, which is around a 3 to 4% rate of return, which is what we saw in our median estimates. But if we acknowledge that we may be able to reduce our variable OPEX costs over the life of the project, for an example, then perhaps we actually move a little bit down that cost curve, and we're able to start to see that in our P10 cases, or our best 10% of cases, we can actually receive over a 10% rate of return on this project. If that's not a level of risk that the company is comfortable with, then we can say, well, it looks like we'll have to increase our service fee, or perhaps negotiate a carbon credit sharing or a CapEx sharing agreement. And so we like to do our things on a distribution and a scenario analysis basis. And the last thing that we get from our evaluations is a sensitivity analysis, and we consistently see this from a hub operator perspective. So this excludes any carbon capture facilities. This would look different if carbon capture costs were included. Again, this is simply a 64-kilometer CO2 pipeline, as well as the centralized injection hub of 3 injectors. And so what we consistently see from a hub operator perspective is what you can charge as your service fee tends to be the most impactful piece to your economics, followed by capital costs. Those 2 pieces really tend to make the biggest impact on CCS hub economics.
We just wanted to finish off just to kind of reiterate some of the things that we have observed as being requirements for success with the carbon capture and sequestration industry. Regulation, we always see that regulation is required to allow, support, and even incent CCS development. The economic success of the project is critical for investors and organizations to participate in this. And lastly, we didn't talk about the technical, but geology, and obviously Argentina is well equipped to have the geological opportunity for CCS. So thank you very much, and enjoy the conference.